Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. And as always, I am joined by my partner, all things Fed, rates, and liquidity, Gregory Faranello. Hey, Greg, how are you?
How are you, Michael? Good morning.
I'm doing wonderful, thank you. And we have a special guest today, Kristina Hooper. We're very excited to have you here. The Fed is such in play lately. And, the last meeting I said, this is probably the most anticipated meeting we've had in quite some time. And here I find myself saying the same thing as I think we might be coalescing around 25, 50, I guess, is still in play. But I think the real question might be pivot versus pause and where that kind of all plays out here. So, Kristina, so grateful that you're here today. And Greg, take it away, please.
Thank you, Michael. And Michael, I echo that. Kristina, it's great. It's great to have you with the AmeriVet family today. The way we generally like to do this is to sort of dive right into it. And I've got a couple of buckets for you today to share with us, to share with our clients. What I'd love to do is start with the issue at hand right now, which is the meeting on Wednesday. Like Michael said, the market is priced for a certain scenario. And then I think the markets are going to be looking very closely at what Jay Powell has to say.
Absolutely. I mean, I think that this is one of the most anticipated meetings because we are getting so close to the end, in my opinion, in terms of rate hikes. And in fact, I took a lot of comfort from our neighbors up north last week. The Bank of Canada came out with a rate hike, but with a pause. What they're terming a conditional pause, which I think is a wonderful playbook for the Fed to utilize. In that, they're saying, we need to take time to assess the impact what's happened thus far to the economy because of all this aggressive tightening. But we also need to be on our guard that inflation doesn't become entrenched, doesn't become a problem again. So we reserve the right to step back in and start tightening again. And I think that's a great formula. I don't think that the Fed is going to take that page from the BOC's playbook immediately. I think we'll get a 25 basis point hike this week. But I think at the next meeting, that's when we're likely to get our last rate hike of this tightening cycle, and we will get that conditional pause. Maybe I'm a cockeyed optimist, but I'm certainly hopeful, and I do think it's possible.
So this notion for higher for longer doesn't seem to be working all that well, right? With these rate cuts priced in later in the year. We look at markets to start 2023. You and I were talking before we started this segment of what a crazy year 2022 was. We've seen a ton of corporate issuance. Treasury yields are doing great. Credit's doing great. Equities are doing great. Even crypto Bitcoin is doing well. I'd love to get your thoughts short term here and then your outlook, bigger picture throughout the course of 2023.
Yeah. And Greg, I apologize because I didn't address your question about pivot. Yes, I think a pause is imminent, but or relatively imminent. I don't think a pivot occurs. In other words, rate cuts occur this year, even though the market expects it. If it happens, it's because the economy deteriorated a lot more than I expected. I think we're going to get a soft-ish landing if the Fed can stop tightening soon. So let's talk about these opportunities that you mentioned. And I think that what we've seen thus far with risk assets performing well, and of course we have fixed income giving very nice, robust yields after years of really yield scarcity. It's a far better environment than 2023. And I think we should, though, assume that there are going to be some headwinds this year. We've got earnings. Earnings are likely to get downwardly revised significantly. That's just what happens in an economic downturn, and clearly we're seeing a deceleration. So that will provide a headwind. The good news is that rates falling tend to be a tailwind. What we've seen historically is that when the 10-year comes down, that results in multiple expansion. So I think of this as something of a tug of war, where we're likely to see some volatility, especially earlier in the year where there's an awful lot of market uncertainty, which also uncertainty in general, I should say, policy uncertainty, which often fans the flames of volatility. We don't know what is going to happen with the Fed. So we're going to be guessing until they actually come out. We also don't know what's going to happen with the debt ceiling later this year. So there are going to be a lot of ifs. And I think that's going to contribute to volatility. But I would expect that once we get more visibility on what's happening, I think later in the year, as markets start to discount a real economic recovery, that's when I think we'll actually see a more supportive environment for risk assets.
I love that expression, tug of war. It makes a lot of sense right now when you see what the Fed is saying and at the same time how markets are reacting. But I think to your point initially, the end game feels very close, and it feels like the markets are anticipating that. With regard to the economy, we have an employment number this Friday. Seems like the employment market has held up fairly well, although we're seeing some layoffs here and there. The claims numbers are still low. You look at the JOLTS report, it still feels pretty tight. I mean, what's your view on the economy and maybe how the employment picture evolves throughout the course of 2023, and then ultimately what that means for the Fed?
Greg, this is, I think, a very unique labor market because of all that we've experienced over the last few years. We have low labor force participation. It's a combination of immigration policies implemented years ago, as well as the fact that the risk reward profile for jobs for many Americans changed with COVID. And so for many, let's think of retirees who enjoyed working part-time to supplement Social Security. Suddenly they might not want to work that retail job. And I think those calculations have altered the landscape. So we have that force. We also, of course, have a decelerating economy that is causing employers to announce layoffs. I mean, it's been very, very prevalent in the tech industry, and the headlines are all over. And I think it's going to spread beyond that. But as you point out, it's a very tight labor market, and I don't see us getting to an unemployment rate above 4.4%. It just seems unlikely, given that what we've seen in the Federal Reserve Beige Book, peppered throughout the 12 districts, are comments like, it's hard to find labor. We don't want to lay off employees because we're operating with a skeleton crew. So we're going to try to ride it out and keep our employees. So there's a real desire to hold on to employees. And I don't think we need to see big layoffs for inflation to come down. And that's because the other part of the calculus is job openings. Job openings are very high relative to norms. Pre-pandemic, the run rate was less than 7 million. We're now at 10.5 million, which is down from where we were. And I think that we have to recognize wage growth is driven not by unemployment alone, but by labor mobility. That concept that if I'm working at a retail store and across the street, they're offering $2 more an hour, my employer might be inclined to give me an increase just to retain me. I don't have to actually leave to go there. And so if we see job openings come down and some layoffs, that can take us to a more comfortable level of wage growth for the Fed. I think the Fed recognizes, though, that wage growth is going to be elevated for some time, that's going to be the stubborn part of inflation, and that I still think they're going to be willing to hit the pause button soon, just because in general, the direction of travel for inflation is moderation.
Yeah, that's excellent. I mean, I guess that is your scenario that you started out with. You think we could have a softish landing by a number of different factors coming into play. It doesn't have to be all one way. And I agree with you. That would be great for the economy. Probably great for markets too, right? In the end. Mike, I'd love for you to jump in here, if you will.
Sure.
I'm gonna pass it back to you, like I always do.
Well, I appreciate that. And Kristina, Greg and I have been doing this for years, and he always gives me the privilege of, what I say, bringing a curveball in, or at least asking a question or something that's on my mind. I think the one thing that I found interesting in all my readings over the last few weeks is, and I've had the good pleasure of watching him live, is Larry Summers' comments. And he's been extremely hawkish, but his last comments actually gave me pause for some hope to a lot of what we're talking about today. And if you could comment on that, I'd greatly appreciate it. Thank you.
Sure. I think that Larry Summers was very, very right about inflation. He called it early. And so I think that there's certainly a lot of reason to listen to his views. I just think that we are at a point, and I'm encouraged that that he's certainly, I think he still expects the Fed to hike rates significantly more than I would anticipate, for example. But I think it's important to recognize that that is a very real possibility, right? That inflation could become entrenched. And that's why it's so important for the Fed to not go all in on a pause, but to follow the lead of Bank of Canada and say, this is going to be a conditional pause, right? We're going to be laser focused on this. Because I think Larry Summers was right to raise the alarm bells a lot sooner than really most did. And I think we need to keep that in mind. It's something akin to the 10th man rule, right? That idea that apparently the Israeli army utilizes, where they say if 9 people agree, it's the 10th person's obligation to disagree and think about what that scenario would be like. So I think we need to recognize that we have to have a lot of humility in terms of the outlook and say, let's have some safety valves in case this doesn't go according to plan.
Yeah, that's amazing. Greg, I think we might close up. Yeah, it's going to be amazing to watch. And, I keep thinking about how long we've been doing this, Greg, and to have guests like Kristina and have their expertise and have conversations like this, quite honestly, just for us and for our clients to get to participate and see this, we're very grateful, Kristina. So thank you so much for being so generous with your time this morning, and super looking forward to everything. Greg, you know what this means to me. Love doing this segment. So if any of our clients have any questions, obviously Greg is always available, and we wish everyone a great week and a continued great start to the year.